Good afternoon, class. Do you hear me? Okay, thank you so much. Thank you for the homework number 6. You guys have done a great job. I just returned the feedback to one of the members, Jam, Ping, and the last one, Kiwi. Okay, thank you for your doing a good job. And today I'd like to continue chapter 5 and finishing up with the corporate profitability analysis. Before I go through all the rest of the material, I'd like to maybe discuss with you the homework that you have done, right, on the 3 cases, on white cards, Luckin Coffee, and hers, okay? And I will start with something simple, okay? Can anyone in the class tell me, or maybe give me the highlights of the first corporations, the white cards? So what happened to white cards? Anyone at all? Give us some snapshots. Anyone?
So basically they have the $2 million, and they cannot tell like where it is or whether it exists or not, and they assume that they put it in the escrow account, which is like the account for, it's like the trust between 2 parties, like because like this company, the nature is like is like the media for online purchases. So basically it's like the trust between buyer and the supplier. Okay. And when the audit look in this account, there's no like money at all.
All right. So Amy, what you are trying to say that some assets disappearing or maybe never been there, right? Maybe artificial asset. Is that correct, Amy? All right. So Amy, would you help us to maybe transform what you have said into the graphic, right? So this is the balance sheet. Okay. So what happened to the assets? Overstate or understate in this case?
Overstated.
And could you please pinpoint what type of asset, current or non-current, you think?
I think it's current asset.
Yeah, I agree with that as well. Maybe I'm wrong, but I believe that based on story, it should be some kind of current asset, but for sure that's an asset. Agree? All right, so put just asset overstated. So Amy, what happened to liabilities?
Nothing.
Nothing?
Oh, wait.
Wet. Okay, wet what? Okay, wet what?
Like from the news, this account, the company still have to pay to the supplier.
Okay.
I don't know if we mean the same account or not.
Okay, I think something with the asset, but I think well, for sure, I think liability is not affected. It's just some fake asset in escrow account based on the story. So I don't think that the liability is in effect, but it's affected. But OE, what happened?
No.
Are you sure,
No.
Amy? Otherwise, the balance sheet is not balanced, right?
Oh yeah, is overstated.
Overstated. What account in OE is overstated, in your opinion?
Is it retained earning?
Retained earning overstated. And why would retained earning be overstated? Because the profit is overstated. Is that correct? Right? And what make the profit being overstated?
Because they put the fake sales.
Okay.
That's fake profit.
All right. So is that what you have trying to say?
Yes.
Okay. So basically, fake revenue, artificial, right? Fabricate, right? That's the word the groups have been using in the homework. Fabricated, fake, right? Or bogus, right? Revenues, and then put some kind of artificial money into escrow accounts, right? So this is might be what you have trying to say in the homework. So in this case, Amy, if we have this kind of picture, it would affect some ratio. Is that correct? Good. Okay, Amy, thank you so much up to this point. Other people, could you give us some example of the ratio of wildcard that might be affected by this accounting scandal? Anyone?
Maybe that to equity ratio.
DE rate, is that DE ratio? Is that
Right,
what?
yes.
Okay, so could you elaborate a bit, Pink? So
Like equity. Yes.
go ahead.
Yes. Equity like maybe overstated, causing like the ratio to be understated.
Okay, so Pink, since you bring this up, could you provide some more ratio besides DE ratio?
Maybe quick ratio.
All right, so then what happened to the whole thing? CL might not be affected, right? And quick asset. In this case, you have to assume that escrow account is in the current asset. Is that right, Pink?
Yes.
Right. So then that one goes up, the whole thing will goes up. Make sense? Okay. And this is what I'm trying to show you that based on what we have discussed so far, you can integrate what I have discussed with you or have taught you in the class, right, to see the impact on the financial statement of wildcard. And Ping, the last question to you, what type of motive that make wildcard doing this kind of thing?
If it related to like, it can be like about bonus or like the market to make market.
Okay.
Oh wait, it can also be like relating to like creditors and debt, so they could maybe like have a lower DE ratio and which like could borrow more like that.
Okay, so basically it's go back to what we have discussed in the class about the capital market motive or contracting motive. Is that right, Ping? It can be from
Yes.
the pressure that they're trying to, you know, make themselves look good to the creditors, to investor. Agree? Okay. Thank you, Ping. Okay, let's go to the second company on the homework, which is the Luckin of Coffee. Luckin Coffee. Anyone at all?
They are like misstating the revenue and expenses so that like the company can compete with other big company like Starbucks. But by doing so, they created a fake transaction so that they can put like fake revenue in that.
Okay, so basically they go ahead and do the same. Say what do I say? Well, twin effect. I would say they're trying to paddle the revenue and expense in the same time. Is that right, Nachapat? Okay.
Yes.
So I'm sorry, Nachapa. Please forgive me. All right, Nachapa. So together with revenue and expenses, correct. So what happened to income statement? What happened to EBIT? Overstated or understated?
Overstated.
Overstated because at the end, right? Even though they put inflated revenue and inflated expense, but net effect, then EBIT will goes up. Agree, Nachapa? Okay,
Yes.
and that makes the RE overstated and OE overstated. Is that right, Nachapa? Okay.
Yes, correct.
So then on balance sheet effect, I cannot really tell what happened to assets and liabilities because we don't know really what they did in detail with the asset and liabilities. But all we know is that OE is overstated. So we don't know about L and A based on the story because we don't know inside what happened, right? All right, so again, if OE is inflated, resulting from the EBIT being overstated, then you can see that the profit, right, is cooked. In other words, is managed. Is that right, Nachapa? So in this case, is this upward or downward earning management? Upward.
Upward.
All right. In this case, Nachapa, would you like to say fraud or earning management?
I would say like earning management.
Is that can it be fraud in this case? What is the line between fraud and earning management based on the discussions?
The IFRS.
The IFRS, violations of the IFRS, is that right? You think Luckin Coffee did this kind of thing? Did they violate the accounting standards?
Yes, maybe.
Yeah.
Not sure. I think yes.
Okay, so Nachapa, that's okay. How about other people, other students? Please help Nachapa. Anyone? Is this fraud or earning management?
I think it's fraud.
Oh, why so?
Because they intentionally like overstate the revenue, so it might be like fake revenue.
All right. So Laksanapan, so in the case in the news on the assignment, did they get caught?
Yeah, and they have to pay penalty too.
Is that okay? So they pay penalties. Okay, fine. So Luckin Coffee, right? So then, you can see that for the first one, the white cards, right? They did abuse the earning, and Luckin Coffee they did abuse the earning. So Laksanapan, so for Luckin Coffee, what would be the motive behind this story?
I think it's the capital market. They want a good IPO price.
Okay. Is that what we have discussed so far in the class? Is that right?
Yes.
I mean, remember the lesson from the class discussion, we talked about two types of the motive. Is that right? And what type of motive is this?
This is earnings management upward.
I know, but what type of motive? We have two types of motive, right? Contracting motive and capital market motive. What type of motive? Capital market motive. Is that correct? So basically, this is what I trying to explain, that the reason or rationale behind earning management. Okay, so in this case, they're trying to get fast in terms of try to get into IPO process. And I think the story talk about the regular time, the time length to get into the IPO process, like, I don't know, 10 years, but this firm trying to get into the IPO process and try to get the high IPO price, right? That's why they commit this kind of thing. All right, thank you, Laksanapan. So next, the last one, which is hers. What happened to hers?
So they disclose inaccurate financial statements and disclosures by revising some reserve accounts, and also prolong the period of depreciation. Okay,
Vimutipan, so could you maybe put into the graphic like this? Okay, try, because when you say it, it's from the news, right? But as a student of this class, you should be able to articulate into the effect on the financial statement. Try. Well, let's recap one more time. How many schemes are there? 1, 2, 3, 4, 5. How many schemes are there? Based on what you have said, how many schemes? 2.
2.
All right. So 2 schemes. The first one is about what?
The revision of the reserve accounts.
Could you please put in plain words? Reserve account. Could you be elaborate a bit? What type of account is that? What type of asset is that?
Is it allowance for doubtful account?
Okay, so basically AR. Is that right? All right. This is impairment. Is that right? How about the second one, the second schemes?
The depreciation
Of
expense.
what? Depreciation of what?
The cars.
The car fleet. Okay. The rental car. Is that correct? Okay. So what I'm trying to do right now, I'm trying to help you and the other students to visualize the pictures of this, right, accounting scandal. So Vimutpon, thank you so much. Up to this point, you are fine, right? How about other students help follow me? Please, other student, could you please put this into the effect on the balance sheet? Anyone? Anyone?
Yes, Habasan, I can help you.
Okay, good. Go ahead. So could you please take care of the first schemes? What happened to the balance sheet?
So the first one is AR impairment. So they're trying to decrease, so the AR will increase, Habasan.
You mean like overstated, right?
Yeah, the AR will be overstated.
AR overstated. And what happened to the other sides? L and OE.
L and OE. For L is just normal, Habasan.
Okay,
But
not affected.
for the and for the E, it will be it will be overstated, because it will have bad debt expense.
Okay, so bad debt expense resulting from, I'm sorry, EBIT being overstated. Why EBIT being overstated? Because expense is understated. Am I correct based on what I have written?
Yes, Kabajan.
Okay, thank you. Good. Could you try maybe the second one as well?
The second one is for depreciation, right?
Yes.
So it will. So the asset will be overstated.
Okay, so basically PPE, right?
Yeah, the PPE will be overstated, and the OE will be understated because the depreciation expense understated, overstated, right? Oh, I'm kind of confused now. Okay.
No.
Sorry.
You are in a good shape, but try. See, your friends are laughing at you. Okay, your friends are laughing at you. I'm just, Okay, here, OE is overstated, right? Because RE is overstated. Why so? Because EBIT is overstated. Why so? Because depreciation is overstated. And why would depreciation be overstated? Because what they did. Good. Do you remember?
Depreciation should be understated, right?
Understated. Okay. Yeah. My bad. Sorry. Depreciation is understated. Why so? Because what they did with the useful life, or maybe the mileage driven. First of all, do you agree? Okay, maybe you can tell me what methods of depreciations have the firm been using?
Straight line method.
Are you sure straight line?
I didn't do.
No, that's fine.
So.
That's fine. Good. Good is good enough. All right. Other students, could you please tell me what type of depreciation method has they used? What type of depreciation method have they used? Is that the time base or usage based? When I talk about the time base, what would be example of time-based depreciation method? Can anyone just give me some example?
Time.
Is that Yanin? Is that you? All right, Yanin, say one more time.
Like the useful time.
Well, your answer is kind of mixed between the two. You make like the two into one. Wait, one more time. What would be example of the time-based depreciation? The time-based depreciation means that if you don't use or utilize the asset, you have to depreciate anyway, right? Okay, and what would be example?
Like the straight line.
Okay, straight line depreciation. What else? Oh, this is go back to intermediate accounting one. All right.
Declining balance.
Say one more time.
Like declining balance.
Okay, DDB. And how about S by D? Sum of the year digits. Is that right? How about the usage page? What would be example? Can I say unit of production? Is that all right? Yanin, could you elaborate a bit? What would be the concept behind unit of production?
Like, is it the amount of expense per unit?
Okay, for example, if I depreciate the car, right, I can use the time base, which is a straight line, by estimate useful life of the car. Is that correct? So then depreciation should be the cost of the car minus the salvage value over the useful life of the car. Am I correct? But if I calculate depreciations of a car, in this case, by using the usage base or unit of production, I have to take the car over what?
The car.
Can I depreciate the car based on the mile driven? Is that possible?
Could you repeat the question again?
Okay, here. Is that possible for the firm to depreciate the depreciation of the car by using the number of miles driven? In other words, if I have a car, I might estimate the total miles, right? That we can use this car, for example, 1 million baht for 100,000 miles driven. So then I can calculate depreciation per mile. Is that possible?
Possible.
Right. So this is called usage base or unit of production, right? So Hertz employ not the time base, but the usage based depreciation. They employ the depreciation methods of the mile driven. So up to this point, thank you, Yanin. Can anyone tell me what happened to the depreciation method in this case, or what exactly happening with the mile driven in this case? Okay, give you a hint. Based on the assignment that you have done to me, you said that the company understate the depreciation, right? That's why the EBIT, right, goes up. So if they want to understate depreciations of the car, they have to do with something to do with the mile driven, like Vimutpon mentions, right? So what I ask you is that, could you maybe tell me what exactly happening with the mile driven that make the depreciations kind of understated?
Do they record the miles lower than the actual miles driven?
You mean like they overestimate or underestimate? If they underestimate the miles, I mean, if they underestimate the mile, it means that depreciation per year or per mile is gonna go up. Is that right? Right. Okay, Laksanapan, they change the mile driven. Okay, basically they change the estimations of the mile driven. Laksanapan, when they change the mile driven, make it longer, what happened to depreciation?
If it's longer, then the depreciation is going to be higher than the actual.
Higher or lower?
So it's like longer useful life of the asset.
Yeah, longer useful life, longer miles driven, lower. Exactly. This is what happened. They change the estimations of the rental car, right? They change the estimations of the rental car. They make the estimations of the mile driven longer. That's why the depreciation goes down. Okay, then that's make the whole thing what? So you can see that the asset overstated, right? And L, nothing effect in here, nothing to do with L, right? Just the asset overstated and equity overstated. Okay, in this case, when you look at the Hearst story, all right, what kind of ratio that we have to be careful when we analyze the financial statement? Anyone? Anyone? What are examples of the ratio that you have to be careful when you analyze the financial statement of Hearst?
The DE ratio.
All right, the first one might be DE ratio. Okay, now you know if exactly what the effect is, right? But DE ratio, that's one. DE ratio tends to be overstated or understated. If that is understated, okay, good. What else?
Maybe AR turnover, but I'm not sure.
AR turnover, yes, okay, because the sales AR turnover, yes or no, good. What is the formula of AR turnover? Let me write down first based on, well, DE ratio, you said DE ratio. Let me write down. Give me time. DE ratio, that no impact, equity goes up, right? Make the whole thing goes down, understated. And then, good, you say AR turnover. What is the formula of AR turnover?
The AR turnover is revenue divided by the AR.
Okay, what happened to the revenue?
So the EBIT is increased.
Okay.
Oh, and the AR is also increased.
Hold on a second. I am asking what happened to revenue, not EBIT. Is EBIT equal to revenue?
No, EBIT is not
equal to right? So what happened to revenue? Good.
We don't know. Right?
We don't know, meaning no impact, right? Because it has something to do with this, okay? Revenue, okay? But you have to listen to me. This case is very, very interesting, and you have to comprehend this case. But at the first effect, revenue is not impacted. What happened to AR?
AR is increased.
Why?
Because like the bad debt expense is decreased, so it will impact the net AR to be increased.
When you use the AR turnover, think about my midterm exam. When you use AR turnover, calculate AR turnover, would you use AR net or gross?
Oh, we use
gross.
AR. Yeah.
Thank you so much. So AR gross, right? If you use AR gross, what happened to AR? In this problem, no impact. Is that right? No impact. But good, you bring a good point in this case, because normally when people calculate AR turnover, I believe that they are using the AR net. Okay. But I mean, your answer is not wrong. It depends on the insightfulness of the analyzer, right? Or the formula that they have been using. Okay, so I'd like to put some discussion on this one. In this case, is that just the really earning management? Does it have to do with the impact on the strategies? Well, I would put this one, ATO, asset turnover. Asset turnover equal to revenue or asset. I believe that you might say that the asset overstated. Okay, asset overstated. Okay. How about revenue? Now, it's going to be very difficult questions. And trust me, if you help answer this question, I will not put this question on the final exam. But if you don't answer, you will see this question in the final exam for sure. Okay, so I would like you to provide an argument, right, to support that revenue is not affected. And in the second round, I would say, could you please provide me the argument that revenue is affected? I'm sorry, misspelling. That's an A thing, not the E. Okay, so I would like, how many people in the class? 20. Oh, very good today. I like 20, each of the 20, right? Just provide the argument for number 1 and for number 2, okay? And please understand me very, very deeply. When I ask you to provide the argument, it's just the practice for you, because when you work, you need to provide your argument and make sure that your argument is sounded, right? And very convincing. That's why you have to learn, practice, providing an argument in the test, okay? And in here, I would like to hear from you, right? Ajahn, I think based on the hers, revenue is not affected. Why? Okay, let's go. Anyone?
Is it because that what they did only affects the expenses?
Okay, that's easy, right, Yam? Right now, try not easy one, the second one.
For the first argument as well.
Say one more time, Yam.
Are you for the first argument for revenue not affected, right?
No, the first one is done already because it's easy, because all the earning management has nothing to do with the revenue, right? This is what you say, correct? So the first one is easy. That is like kindergarten easy, right? Because the case saying that they are doing the accounting scandal towards the AR impairments and the depreciations, right? So they're not has nothing to do with the sale. That's why the revenue is not affected. So the first one is done. So right now I am asking you about the arguments to support the second sentence that doing this earning management will impact the sales or revenue. It is difficult questions, but I hope that you can try your best. No pressure at all. Yeah. Ajahn, but sounds like you put pressure on me. That's my second voice. Okay. Okay. So yeah, would you like to try?
I still couldn't think of any.
Okay, so can anyone think of this? Can anyone think of this? It's gonna be very difficult because the second one is it has to do with the strategies of the firms. All right, yeah, maybe if I give you some story, you have to look at this problem, right? Not from accounting or accountant's point of view. Think about it though. Yeah, you walk to hers, okay? You walk towards hers. What you want to do is to rent a car. Is that correct? You want to rent a car, and before you go ahead and rent a car, you saw the news about this earning management. Would you dare to rent a car?
No.
Why so?
Because that means the car we're getting might be old and might be broken down while we're driving.
Okay, so what happened to the sales?
Sale will decrease because customer lose like the credibility of us.
That is correct. That's all I asked for. That is your answer for the second one. Are we okay? All right. So then in her story here, right, you can see that hers, right, commit the accounting scandal, well, allegedly, right, and then it will impact not only the short term but also the intermediate term, or maybe just short term right away to the sales as well, even though they can, increase the profits, but then they create some kind of bad reputation, right? on the core, on the, the product of the firms that might somehow, right, at the end, might not skyrocket the profits as they think, right? Because at the end, the sales might go down as well, right? So then the lesson learned from the HERS is that some accounting scandal, some accounting management, well, on one hand, might impact the earnings right away, but also, on the other hand, right, might impact indirectly to the sales. Are we okay, Yam?
Yes.
Okay, thank you so much, Yam, for your participation and all the students. Okay, so this is what I like you to, follow, because I believe that when you go on the job market or for internships, right, when people talk about white cards, Luckin Coffee and HERS, you should know what happens. And then with the integrations of what we have learned so far, you could see that it will address the earning management issue, address the income statement and balance sheet being, overstated, understated. And of course, at the end, we might have to think about recasting. Okay, might think about recasting. Okay, thank you so much for this. And I haven't finished the earning management yet, because as I promised to you, okay, that I would like to talk about this reading for you. Okay, so please bring up this reading. Okay, Deloitte, reading number 3. And I talked to the class last time that today I will cover this. Okay. So I like you maybe take maybe a minute also trying to get ready for this by bringing the reading, because I would like to talk about that in detail. And this even more important, and it is just close to the situation in Thailand. Okay. All right. So please spend time. How about this? I think I wish that you guys have read this article, but if you haven't, or maybe you have read but you cannot remember, so why don't you spend 2 minutes try to skim, please skimming this reading in 2 minutes. Okay. After that, we will discuss about this. And please, this is very good reading. 2 minutes, please. All right, so if you haven't finished reading, you can do it at your leisure time, but I like to talk about this. And don't worry much about trying to answer the question, but at least you have to use your rationale or judgment based on the knowledge that you have gathered along the way. So I would put this as an argument. Okay, so first we have study motive, okay, for EM. And I explained already 2 types of motive. The first one is contracting motive. The second one is the capital market motive. We know that. Okay, and then we have the situations right now, COVID-19. All right, let's start with something simple. Can COVID-19 situations motivate the management to commit earning management? Can COVID-19 situation lead to EM? Anyone?
Yes ค่ะ
Okay, yes, Ka, and who are you?
นัชภาค่ะ
Anajapa, okay, sorry, yeah. Yes, Ka, all right, so could you elaborate a bit why yes?
I think that the COVID-19 makes like economy of Thailand and every country goes down, so that customers have like less spending, making the sales of the company drop, so that they want to like maintain the same target. Maybe they will do the earning management upward to get the same like profitability.
Okay, so and am I all right to conclude that way? COVID-19 is believed to affect the economy adversely, right? That then it results in the sales going down, but expense going up. That's why made the performance of the firm goes down. Are we okay?
ค่ะ
Okay, so then that provide a motive for the management of the firms, especially listed company, to manage earnings, right? So in this case, would you believe is that going to be upward or downward EM?
upward ค่ะ
Upward. Okay, so it is expected that the firms will do the upward earning management, even fraud. Is that possible?
yes ค่ะ
Okay, so EM and the fraud. Okay, so could you please tell me, anyone, thank you, Nashapa. Can anyone tell me if you want to commit, well, please do not go ahead and commit earning management, right? In reality, I am not teaching you to commit earning management, but I'm teaching you to be aware, right? In this case, and based on your friend's argument, right, the firm might abuse the performance by, right, manage the earning upwards. Okay, so by manage earning upwards, you might want to manage the revenue to be like overstated and understated expense. Okay, could you please explain to me how would they do that in detail? How so? Anyone? They want to stay away from, poor performance. They're trying to make the performance look good, look artificially good. That's why they're trying to upward EM by inflate the revenue and deflate the expense. So how so? For example, go ahead.
bogus revenue.
Bogus revenue. Okay, that's first one, right? Maybe they're trying to make the fake or artificial revenue, maybe similar to what happened to Luckin Coffee. Is that right? Okay. All right. Thank you so much. How about other students? Please give me the example. Good.
They may speed up some revenue, some kind of that, like
Okay, speed up. Okay, acceleration, speed up. Okay, speed up revenue. Okay.
And then
okay.
Lower expense.
Like lower expense, could you maybe give some example about accounting principle, how to lower expense? Since we have talked about things.
They can maybe like record the expense in different accounting periods, some kind of that. So they can lower revenue.
Okay. But what I want from you is that maybe you just pick on one story. Okay, pick on one story. Okay. For example, how about inventory? Can we do something with inventory in the sense that the expense can go down, not up, or maybe understate the expense resulting from inventory accounting?
Maybe they can change accounting policy like from FIFO to LIFO, some kind of that.
But if you change accounting policy like that, it's gonna, well, you don't know for sure because it depends on the prices
Yeah.
of the inventory, right? But to be easier than that, good. What happened about the impairment?
They may decrease impairment loss. Yeah.
Decrease impairment loss. Okay, good. Decrease impairment loss. And anyone, thank you, good. Other students, what type of asset, right, must be tested impairment? Oh, this is not a difficult question at all. This is like previous class knowledge. What type of asset, right, that need to be tested for impairment?
AR ป่ะครับ
AR, okay, good. All right, AR, that's first one. What else? Talk about
Goodwill.
Goodwill. What else?
Intangible asset.
Intangible asset. What else? Some more, a lot. Come on, guys. AR, goodwill, intangible asset. What else? Big item, very big one, not mentioned yet.
PPE.
Thank you so much. PPE, right? Right. If you know that COVID-19 is not coming up, right, is there, and you are so worried about the performance, right, and you're trying to manage earning upwards, what they might do is to try to say, I will understate the impairment loss. Do you agree? If agree, nod your head. Okay, they will understate the impairment loss, right? The impairment loss, right, can be regarding with the AR, so-called ECL, or goodwill impairment, or intangible assets, PPE, or even like investment property or the investment. Okay, so you can see that this is a point where if you want to audit the companies, okay, in the last year in 2020 or this year, you have to be careful about this kind of point because the company might have incentive not report, right, numbers faithfully. Okay, so the questions to follow up my argument is that as a role of auditors, are you worried, and what kind of thing you worry about? Anyone? If you were an auditors, and you audit the financial statements of the company in year 2020 or even this year, what kind of thing that you have to worry?
I think it's about the very detailed thing, for example, the impairment test, which is not directly reported to the financial statement.
All right, Salin, right? Okay. So is that Salin?
Salin ka.
Okay. Say one more time.
It's I would be worried about the very detailed things.
Okay.
For example, impairment test or estimation that the company come up with.
All right. How about would you be a bit skeptical about the cut-off sales? Is a sale cut off can be an issue?
Mm-hmm.
It's possible, right? Okay. So then as the auditors, you have to be worried a lot actually during the COVID-19 because you don't know whether the client is good or bad, right? And they might commit the earning management in this case. All right, thank you. How about pretend yourself to be creditors? Pretend yourself to be a creditors like bank. What kind of thing bank must be worried about? Anyone? Think about this question as the interview questions. See, interview question might come in something like, okay,น้อง, you know the COVID-19. If you were the bank or creditors, what kind of concern would you have in mind? See that? This is the realistic questions. Anyone? If you were creditors, what kind of thing you have to worry?
About loan covenant.
All right, go ahead.
Like for example, the company might push up their revenue to maintain in ICR, like
Okay.
for one-time gain, something like that. That company sells the investment so that they will get like high revenue.
All right, that's one thing, right? And I agree with that, Sasanan, right? So, right, see that? So implications of the COVID-19, right, not only impact the auditors, but also impact the creditors. And last but not least, if you were investor, what kind of thing would investor worry? Go ahead.
Investor would worry that the company performance that reflect in the financial statement doesn't truly reflect company performance.
It looks too good to be true. Is that correct?
Yes.
And Sasanan, since you mentioned about this one, when they declare the financial statements of the year 2020, because we are not so sure, right, which company is bad or good, right? But the number on financial statement might a little bit skeptical. Is that correct? Okay.
Yeah.
And do you agree that this kind of situation or the consequences might associate with the stock price being volatilities?
Sure.
Okay, the stock price must reflect this accordingly. Okay, so that's the point of reading this article. Okay, now thank you so much for you guys, and I'd like to go into details of the article. Okay. Okay, so this is the article, the forensic focus on COVID-19, right? They dissect the COVID-19 situation and focus on the financial statement fraud. Okay, financial statement fraud. That's the word for the article, financial statement fraud. And I agree with you, the financial fraud become an issue, right? Too many stakeholders, right? Auditors, investor, creditors, okay? And the article not only address the earning management, right? Not only address earning management and fraud, but also address the internal control and corporate governance, okay? Because when they talk about the COVID-19, the company might have the weak internal control system. That's why, you know, for the internal auditors or, you know, internal control, this kind of people involved with this might be careful, okay? And they talk about the situations of COVID-19, okay? All right. They talk about the pressure, right, from the COVID-19 that make the firm trying to manipulate the financial statement just to satisfy the needs of the stakeholders or trying to meet the stakeholder expectations, okay? And as you mentioned before, if we talk about the listed company or company listed in the stock exchange of Thailand, they might want to meet the expectations of the investor, okay? Then maybe, can anyone tell me, when they're trying to meet the stakeholder expectation, right? Can this be explained by the capital market motive? Can capital market motive explain this situation?
Yes,ครับ.
Okay, why so, Dirk?
Maybe it's about earning per share.
Okay,
Something
earning
like
per
that.
share. And
So,
yes, go ahead.
If the analysts forecast about the earnings that they have to meet, and then they wouldn't be able to meet that type of revenue, so they kind of have a pressure to engage in bad activities.
Okay, I agree with that, Dirk. And then I would like to follow your argument. Okay, so basically depends on the expectation, what type of expectation. If they expect the company to grow in terms of the sale, let's say sale growth, then the COVID-19 might not make the sale growth very handsome, right? They make in turn the sale growth to be very ugly. Then they may have the pressure, right? The management trying to skyrocket the sale growth. That's why they make the sale grow, right? To meet the expectation of the investor. Not just the sales, maybe the EBIT or even like EPS, earning per share. they might want the EPS to be as the investor needed. And if you look at the second page, they talk about this term here, the stock dropped. Okay. Then the second page, they talk about the pressure arising from the stock drop litigation, because during the COVID-19, some bad thing happens, loss, and the profit goes down, blah blah, and the firms don't want to be the targets of litigation lawsuit. That's why they're trying to stay like better than expected. Okay, and again, that is resulting from the capital market motive. Okay, link back to the wild card. Okay, Luckin Coffee, right? The two cases, especially the Luckin Coffee, you can see that the capital market motive put a lot of pressure for management to commit the earning management, even the fraud. Okay, all right. How about the contracting motive? Here you go. You see on the screen, right? Well, financial statement manipulations, right? They're trying to do it because they're trying to maximize the bonus scheme. Could anyone tell me what does this situations has to do with the contracting motive?
Like the bonus is tied with the performance of the company, so employee or like manager might try to like manipulate the profit so they can get like the bonus that they want.
Okay, Pon Prakai Keo. So basically, in this article, right? This article fit well with the two motifs that we study in class. Am I correct? Okay, both the contracting motive and the capital market motive. And for the contracting motive, we have debt hypothesis, bonus hypothesis, and so on. Okay, in this case, right, the story is built on the motive. Then the story built on the point or issue of the earning management. The first one, as I have asked many of you already, that during the COVID-19, okay, the firm might commit into overstating the revenues, right? Maybe they commit the fake revenue, right, or fabricates the revenue, right? Revenue goes up, or else equal profit goes up. Why they have to do that? Because they're trying to stay away from the problems, right? Because you know that COVID-19 will somehow weaken the performance. That's why they have to make up the performance, right? Commit something not good, not faithful, right, action by overstating the revenue. And Kun Good mentions about a couple ways to do that, by do the bogus revenues or accelerations of the revenues. Okay, and that is a revenue story. How about expense story? They talk about two types of the expense strategy, bad strategy here. The first one, understating the allowance and reserve. For example, account receivable, right? AR, inventory. Okay, inventory. They make the inventory and account receivable not being impaired much. That's why they say understate, right? In other words, they try to overstate the inventory and account receivable during the bad day. Question to you guys: during the bad days of COVID-19, is there any chance that inventory and account receivable being impaired? Is there any chance that account receivable and inventory being impaired? Is there? If, please answer me. Anyone?
Yes, for both.
Yeah.
Because
Mm-hmm.
I think for inventory, there might be some obsolete inventory because they couldn't generate that much sale. And for AR, it could be that they're the one who owes the money to them also in a bad situation, and that we wouldn't be able to collect the money from them.
All right. So yeah, what do you think about what you have said? Is that very common last year and this year as well, right? All right. So that's why you have to be careful that maybe the AR and inventory will be a bit overstated, maybe much, I don't know. And then the last one, right? That is impairment. I think we have talked already, right? Goodwill, financial instrument, inventory, blah, blah, might be overstated, okay? Now the next page, talk about this, okay? The one that I put underline big bath. So I want you to maybe read this and maybe discuss with me about big bath, okay? Big bath. But we have two terms there, restructuring and big bath, okay? Now let's go to big bath first. Big bath is a technique, like EM techniques. Is one of the EM techniques, right? Big bath. Can anyone just maybe guessing or trying to answer what the big bath is? Just guessing. Big bath. What does it have to do with taking a bath? Okay. Anyone?
Is it like wash off or like write off all your underperforming assets?
Okay, so wash off. I like the words wash off พรประกายแก้ว okay, wash off. So normally when you take a bath, right, because you feel like your body is dirty, right, you need to wash something off. Is that right? Okay, so then you want to wash off, right, and you say that, well, trying to eliminate the underutilized asset, blah blah, right? พรประกายแก้ว, since you bring this up, okay, and I'm glad that you answer a lot today, okay, with your background of the Little Mermaid thing, right? And do you have Sebastian in there? Not Sebastian. Do you know Sebastian? You don't know Sebastian.
I know,ค่ะ.
Okay, you know Sebastian. That is my favorite characters in Little Mermaid.
Oh.
Okay, I think Sebastian is cool because he talks a lot like me. Okay, all right, here. All right, so พรประกายแก้ว, so big bath. Right, I talk to you and use you, right, as the representative for the whole class and discuss these situations. Big bath happen in bad year, right, or poor performance. Okay, big bath is a technique, okay, that is used in the very bad year, like poor performance year, like this, like last year, COVID-19, okay? พรประกายแก้ว, if you didn't do a good job already, okay, are you gonna commit the additional loss? Right? If you commit additional loss or make the expense go up a bit because you're trying to put the expense from the future and put it this year. You see what I'm saying? Trying to put the future expense to be incurred now. In this case, shift future expense to current year. Okay, so then you're trying to shift the future expense to current year. In this case, you're trying to make the earnings of this year to go down. Is that right?
Yes.
And tell me, by making the current profit goes down, does it sound bad to you? Ariel? Does it sound bad to you, Ariel?
Yes.
But do you care because of the bad year already?
No.
Why so? Why so?
Like, it's already bad, so people like didn't expect much from you this year, so you just like record the expense from the future to the current, so like the future you can have like higher revenue.
That is correct. And And based on what you explained, your answer is perfect. Okay, basically we are doing very poorly already. If we just create some more loss, it's gonna be okay, because people will think that, oh, because performance is poor, that's why you have a lot of loss or lower profit. So if you can put a lot of loss in this year, then people not gonna curious about your performance, right? People can believe that, oh, because it's a bad year, because of the COVID-19, so you have poor performance. Then you just create some more loss, right? Trying to make the profit in the future look good, right? So now, what is relationship between the situation you have mentioned and the name of Big Bath? How come people call this situation as Big Bath? Can you guess? Part of the world.
You like you take everything from the future to like your bad right now, like, so it is big.
Okay, a good guess. All right. So basically, people will say that when it is the word, when people say, "Hey, you take a big bath," it means that that you are very poor already, right? Performance. I'm talking about the performance. The performance is poor already. Why don't you take some more big bath? Take big bath, right? Meaning that make it worse and worse. People will not care. Will not be curious about this, because you can explain because of COVID-19, because of recession. That's why you take a big bath. So big bath, that is a technique of one of the EM techniques, is used when the firm is in poor performance year by putting more expenses, right, at the profits of the future period, right? When you take the big bath, it means that in the future the profit gonna go up. Okay, example of big bath like what, right? The article mentions about restructuring. Okay, maybe you just fire people because that right now we might not operate well. We have three factories, and that we haven't utilized the three factories well, right? Maybe you have the plan to close or closure, right, this third factory in the future. Okay, but you choose to close the factory number 3 now. When you shut down the factory, you have to pay for the compensation. Is that correct, Pornpakai Keo? That makes the expense of compensation expense in the future, but incur this year. Do you follow me? Right? Instead of just record the compensation expense in the future, you choose to shut down now and record expense now. Big bath. Okay. All right. Or maybe something like litigation lawsuit. Okay, you get sued, right, on the trial, and that this case gonna be settled in the future. But then you know that, hey, you know what? Why don't we take a big bath? Then you just make the loss this year. Then the next year, if you are losing the trial, you don't have to put any expense on the income statement. Do you agree? Okay, so now that's a big bath, right? So now if you go back to the big bath story, okay, then the story yes, Kun Good.
Is it like related to tax refund for somehow?
Tax
for the
refund?
For big bath method.
Tax refund. Well, when you say tax refund, you have to be careful, good, because normally the tax refund, you have to calculate the tax based on the profits, not according to the IFRS, but according to the revenue department code or revenue code, right? In other words, the tax refund should be calculated based on Pramon Rasadakon or revenue code. But right now, I'm talking about the IFRS. Okay?
Okay, thank you,
all right, now the big bath restructuring, right? So basically, you might commit into some other events that help you to big bath, make the poor to be poorer, and no one will be curious about your performance. Okay, and just another term similar to big bath, but it is called cookie jar reserved. Ponbakaikel, could you please recommend your friends who love to cook or bake the bakery or cookies?
นิชาพัฒน์ค่ะ
นิชาพัฒน์ นิชาพัฒน์ hello
Hello ค่ะ
okay what type of cookie you like to bake
I don't bake cookie ค่ะอาจารย์
do you like or don't like
I don't like
you don't like okay you don't like cookie but you can answer my question thank you okay
ค่ะ
อาจารย์ why bother asking me all right here all right cookie jar reserve okay I have the jar I have the jar and I have cookies all right so Nishapat when you buy the cookies why would you put the cookie in the jar
to reserve the test
all right reserve the test and reserve for maybe in the future right why don't you eat up all the cookies in one time
it's fat ค่ะอาจารย์
all right okay all right thank you all right thank you for reminding me all right so yeah because you said that well I would reserve the cookie for in the futures so in this case what do you think about relationship between the cookie jar story and earning management
so maybe they save up this year to better perform next year
save up the profits for futures okay is that right set up the profit the current profit for the futures okay so in this case the thing about the jar okay the jar is analogous to balance sheet cookies analogous to profits which is the expense or revenue it does matter all right they will put some profit into the jar and when they are hungry they will eat the profit and remove the cookie in the jar it means that they might put something on balance sheet and in the future when they need it they will remove the balance sheet and release the profit okay all right so then cookie jar reserve will happen not in the bad year but in good year all right cookie jar reserve it is happening in the good year that's why on the Deloitte article they didn't mention about cookie jar reserve but they talk about what talk about the big bath because big bath happen very very much in the bad year okay so in good year all right Nishapat sorry Nishapat sorry
Nishapat
oh sorry Nishapat when you are in a good year you have a bunch of the profit is that correct when you have a bunch of the profit this year what are you so afraid of next year profit
so afraid that next year's profit will be lower
so then what are you going to do well is that possible for you to smooth the earning to save up some current profit and then just put in a jar and in the future you just remove the cookie in the jar and release it in the future is that possible
yes possible
good okay how about this the first technique provision if I do the provisions I debit expense and credit provisions can these provisions be techniques called cookie jar reserve
yes
how so
so you pretend to record expense this year and then next year you like reverse off the expense and record as the gain or profit.
Perfect, right? This is the one of the techniques. Good year, right? The profit is too good to be true. Let's make it lower a bit, reserve it into the jar. So debit, expense, credit, provision. So then you create the provision on balance sheet as a jar. And next year, you just reverse it. Maybe you just put expense this period like 100, but then you know that 100 is not the real number. The real number should be maybe 80, but you put the 100 and next year you reverse 20. Then the profit of next year going to be higher. Is that correct?
Yes.
Okay. How about, Nithapat, how about impairment? Is that possible?
Possible.
Okay. How so?
They record more impairment loss this year.
Then?
And then next year you record less? I'm not sure.
All right. Either record less or reverse impairment. Is that possible?
Oh, yes, possible.
Right. So cookie jar, it has to do with the reversal. Reversal, that is the acting of put the cookie in the jar and eat it. Okay. So then that is a reversal. So then you put when you're trying to put the impairment loss or expense right on the income statement, it means that in the same time you create the jar. In other words, you create the provision or allowance as a jar, and then next year reverse. When you reverse, you take the cookies out of the jar and release as a profit. Do you follow me? All right. So that I want you to understand two terms: the big bath and the cookie jars reserve. Big bath, that is the happening in a bad year where you are so poor in terms of the performance, then you make the poor become very poorer, right, performance by create some more losses, right, and hoping that the current profit gonna goes down even more and no one gonna care because people gonna think that because of the poor performance and next year the profit gonna be better. That is big bath happening in bad year. But for cookie jar reserve happening in good year, you save some handsome profits this year, saving in the jar, and then next year you just reverse it or move it by, for example, create some provisions and impairment and reverse it. Okay, and that is pretty much the terms of the EM. Now let's move on more. Okay, and some techniques that we have talked is the capitalizations of expenses. Right, sometimes you don't want to see more expenses happening. You just kind of postpone it by capitalize it rather than expend immediately. Okay, and disclosure of the fraud. Okay, sometimes we don't have to commit the EM. We might do something called CA, right? Creative accounting. In other words, I have said many times that part of the CA is EM, but some CA has nothing to do with the earning management at all. For example, the disclosure in the fraud. Sometimes, right, the fraud from the financial statements, right, happen nothing to do with the earnings at all. It's just a disclosure thing. Okay, so sometimes in the COVID-19, the company might avoid to disclose, right, avoid full disclosures about the situations. And the rest is just saying that margin manipulations, right? There's a doubts on the margin that the firm say the margin is not as targeted, so they might manipulate, right? And talk about the internal control as well. Okay, I hope that you like this article as I do, right? And I think when you work, you go for internship, now you have a picture. Okay, so now before the break, I'd like to go to the PowerPoint presentation. Okay, so at to this point, I am at the slide 24, and I completely finished the lectures on the earning management. And I proved to you that earning management is common these days, especially the bad year, right? In Thailand, we have COVID-19, right? Financial statements of last year and for this year might be skeptical in terms of the earning management, right? Because people believe that the profit is already worse already. They might do some cooking or cook up some numbers of the profit. And you know that in the practice, we have seen many examples so far. And even worse, the earning management result, right, is shown or reflected on the income statement and balance sheet. Now, when you analyze the company through the financial statements and you have the news about the earning management, you need to be careful on the figures that shown on the financial statement. Otherwise, the analysis ratio going to be misleading, okay? And that is my conclusions for the first part. Now let's take a break for 15 minutes. And when we come back, we'll move on to the second part of these chapters, okay? All right, we will convene at 2:41. Thank you. All right, let's get back to the class. Thank you. All right, so we have done the earning management parts, and the rest of the chapters we will talk about the profitability analysis. And the highlight is not about the ratio, but the highlight is about recasting the income statement. Okay, I am at slide number 25. Okay, well, this is the quick reviews on the performance. When we talk about the performance of the firms, right, we capture in terms of the net income and the OCI. Okay, as you can see that we have the statement, so-called comprehensive income statement, show the performance, right, in the net income parts and OCI parts. Okay, and based on the accounting standards, IAS number 1. Okay, you have the right to disclose the expenses either by nature or by functions. Okay, but the rule is that if you disclose on the face of the income statement, right, of expenses by function, you have to disclose by nature. To see this example, I'd like to show you this. This is the income statements of beauty communities. Okay, as usual, you can see that we have a parts of the net income and OCI and CI. And for net income, you have seen the sales, mainly cost of goods sold. They have a gross profits, other income, blah blah blah. You can see that I put the red arrow, right, to show you that if you see this kind of expenses, for example, cost of sales, selling expenses, and administrative expenses, these are expenses by function. By function. Which is the normal, I would say, normal ways to disclose the expenses on the face. Okay. Normally, when I have seen the income statement, expenses on income statements are shown by function, COGS, SG&A, that kind of thing. But based on the rule, if you want to see the details of the expenses by nature, for example, if you want to know of amount reported as the cost of sales, selling admin, how much of them is the depreciations, how much of them is the employee benefit expenses. It means that you are requiring the firm to disclose the expenses by nature, right? Based on the rule, right? The beauty communities must disclose the expenses by nature. There you go. Expenses by nature. You can see that expenses by nature, they turn the expenses by function into natures. Okay, employee benefit expenses, depreciation, amortization, rental services, blah, 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 blah. Expenses by nature, you can call it like by GL, general ledger. Okay, general ledger. Okay, so the one on top is by function. The one down there is by nature. Okay, so IAS number 1 say you can present either way, right, on the face of the income statement, right? But like I explained, the conventional method is by function. That's why when you see the income statement, you see the cost of sale, you see selling, admin, but you don't know the details of by nature. That's why the standard required the disclosures of expenses by nature in the footnote. Okay. Now, if someone asks you, could you please tell me what is the total employee benefit expenses? There is no way you will find the total employee benefit expenses on the face. You need to find it on the footnote. Okay. Again, by function, I would say that you should know the usefulness of by function, because when you separate the expenses by function, it allows you to analyze, for example, gross profits, EBIT, right? That we have studies, right? Of course, I mean, if the company disclose the expenses by nature on the face, right, of income statement, there is no way you can calculate a gross profit. The gross profit can be calculated only by expenses functions. Okay, so what is the good things about expenses by nature? By looking at the disclosures of expenses by nature, it helps the firm to forecast, right? For example, if you want to forecast depreciations of next year, you better know depreciation of this year first, okay? That is the usefulness of the expenses by nature. Keep in mind, if you want to know expenses by nature, you have to go to the footnotes. If you want to know by functions, you have to go on the face, okay? And the last bullets on this slide, I think you have seen many times, okay? The earning quality triangle, right? We have to focus on 3 attributes: cash, core, and recurring. All right, some more of the performance analysis, right? When we talk about the revenue stories, right, revenue must be consistent with the relevant IFRS. We have seen many cases in reality regarding the accounting scandal that somehow artificialize the revenues or sale, make the bogus revenue. So make sure that the revenue figures are consistent with the relevant standards. All right, okay, fair presentation, principal versus net, okay? Depends on the presentation, okay? For example, if I ask, for example, Yanin, all right? I said, Yanin, could you please collect the money from me, right? 100, and I will give you 10, right? Give you 10 in return, right? In other words, Yanin will collect the money on behalf of me of 100 and then submit to me 90, and she will keep 10. The question to Yanin, ready? Yanin, in your income statements, would you present the revenues of 100 and then minus expense of 10, or would you present the revenues of 90? 1 or 2?
Could you repeat the scenario again?
Okay, I would like to collect the money from my account receivable, but I don't want to do it by myself. So I hire you, Yanin, to help me collecting the money from account receivable, right? I say to you that, Yanin, when you collect it, right, 100, you can keep it 10 baht and submit it to me 90. Okay, so then, oh no, the other way around. Here. You keep 10 and give it to me 90, right? You collect the money 100, you keep it 10 and give it to me 90, right? So I ask you back, on your income statement, would you present number 1, revenue 100 minus expense of 90, or number 2, revenues of 10? Are we clear about the questions?
I think so.
1 or 2? Are you the agent or principal in this case?
Agent.
Agent. So agent must record the revenue on the net basis, which is number 2. Okay? Because what you earn is to earn a commission. Is that correct?
Yes.
If you record number 1, it means that you have to have the cost of service of 90, but you don't incur any cost of service of 90. Is that right?
Yes.
All right. You can see that either case, right, EBIT will be equal, which is 10 and 10. Is that right, Yanin?
Yes.
All right. So can we argue that, Ajahn, method 1 or method 2 is well, both methods are the same because they result in the same EBIT. Can we say that?
No.
Because the sales are different. Is that right?
Yes.
Right. And it will impact the growth of the sales, right? So be careful, fair presentation of revenue, right? Make sure if you were agent, you have to present net as number 2 method. If you were principal, you present as number 1 gross method, okay? Thank you, Yanin. Comprehensions of the natures of expenses incurred, right? When we try to analyze expense, right? You have to understand that some expenses are, right, arising, well, with some causes, all right, not the same logic. For example, some expenses, right, are incurred based on matching concept. Can anyone tell me or give me example of the expenses arising based on the matching concept? When sales goes up, you can see that this expense might be incurred. Could someone give me example? What would be? Yes, thank you, cost of goods sold. Thank you so much. Right, cost of goods sold, that's one of them, because sales goes up. You have to say that when we make a sale, we have to incur cost of goods sold, and partially, I would say commission. Right, commission expense or some of the marketing expense. Not all, right? Because commission expense, marketing expense, right, have some relationship with the sales. That's why I call matching. It doesn't mean that it has to be like 100 to 100 or 1-on-1. It might be some partial relationship as well. Then the first category of the expense here will be easily analyzed, because when sales goes up, you are expecting that those expenses will go up or change accordingly. How about number 2, expense, right? What would be expenses arising based on the period? Has something to do with the sale. Sale go up or goes down, you have to incur expense anyway. It happened for a period, so-called period cost. Can anyone give me some example?
Depreciation.
Depreciation is not on the period cost, it's based on the utilization. Depreciation is the next category, right? How about something else?
Is it rental?
Rental, all right, rental, that might be one. How about the employee benefit expense? Okay, right, if you still hire people, employee, right, you have to pay anyway. Rental, insurance, okay, insurance expense, right, it goes by period. Okay, number 3, systematic allocation. I think third answer already. This is depreciation, amortization. Okay, it happens because we're trying to allocate the cost of using PPE or intangible assets systematically. That's why we call systematic allocation. Okay, the first 3 are okay, and then when you analyze, I think you can see that for the matching concept, right? Sales goes up, sales goes down, those expenses will change accordingly. Period cost has nothing to do with the sale. Sale up or down, it doesn't matter, right? We have to incur the period cost anyway. So period cost, right? Normally they are fixed costs, right? Systematic allocation depends on us to allocate, and it's called for judgment as well. The last 2, impairment loss, right? We know this impairment, right? Very well, right? Write-off expense, right? Provision, you know provision as well. The last 2 here are subject to judgment and are easily managed. Judgment and earning management. You have to be careful. Impairment, write-off or provisions, right? Be careful, because we have seen the article talks about that as the techniques for big bath or even cookie jar that we discussed. Okay, among 5, I would say that the last 2 are of low quality earnings. Okay, and the next issue for the bad debt, provision, impairment, be careful, because these 3 can be reversed. Okay, and reversal of the bad debt, impairment or provision, right, can cause the fluctuations of the earnings and can be thought of the tool to manage earning. Okay, like the cookie jar reserve. Be careful. All right. So again, right, when trying to look at the profits, right, look at the revenue and expenses, be careful about this type of items. Okay, and the last bullet on this slide, I think you know before today that, right, when you trying to analyze the profit, sometimes we calculate EBIT, sometimes EBITDA, sometimes NOPAT, or even like core operating earnings. Okay, then EBIT is not reported, right? Some are reporting EBIT, but you cannot see NOPAT, EBITDA, or core earning at all on the income statement based on IFRS. You have to recalculate. That leads to the next section, right? Recasting the income statement. Okay, and please pay attention to this section carefully, because I'm gonna ask you to do some recasting the income statements on the final project on PTTOR as well. Okay, now take a look at this one. I have the income statement and I reformat or recast. I put the sales minus cost of goods sold have gross margin minus operating expenses. I call by myself core earnings step 2, and then I just put the other income and other expenses together in one place. Then step 3, I have the earning before interest tax and the equity income. I hope that you recall equity income, right? Equity incomes arise from the profit or loss share from associate or joint ventures under equity methods. Then step 4, I have EBIT. Step 5, I have EBT. Step 6, I have net income. So please, I will discuss this with you, but right now, I'd like you to spend 5 minutes, 5 minutes, okay? 5 minutes, see each line that I construct this, okay? And then I call it recasting the income statement. So from now on, when you're trying to recast income statement, you're gonna see this kind of format. So please spend 5 minutes, take care of the format and read through the case A, B, C, and D. And after 5 minutes, we will discuss this. Thank you. The class will convene at 3:07, 5 minutes. Please spend time reading. All right, so I have this format for you, just for the future reference. When you are asked to recast the income statement, this format is good for analysis, but not good for IFRS based. Okay, because for the IFRS based financial statements, they are not required this way. Okay, and this method requires a lot of judgment to justify the core earnings. But anyway, right, for the analysis, you have to do this. I have part A, version A, B, C, and D. Let's see the 4 scenarios. You can see that for all the 4 scenarios, you start with the same sales or service render. And at the end, you can see that the net income will be equal across the 4 scenarios. All right, so first question to you guys. If you are asked to calculate profit margin, what is the answer of profit margin? What will be the answer of the profit margin?
0.25.
0.25 or 25%. Is that correct? Okay, thank you so much. Thank you so much. That is 25%. Okay, because when you calculate profit margin, that is the net income over the sales. Is that correct? Then the profit margin will be 25%. The question to you, it means that we have exactly the same profit margin for all the scenario. Am I correct? Am I correct? Okay, so then if I get all PM of 25%, does it mean that the firm A, firm B, firm C, firm D performs equally? Do you agree with this statement? You think that all the firms perform equally? No, right? Okay, Salin, you check your head. All right, you said that you disagree that all the firms perform equally. Why would you say so?
If look at the line, like other line that is not bottom line, they didn't perform well in terms of like core and non-core revenue.
All right, now you just speak sounds like professional, all right? Because when you look at the big picture, now Celine, can we just take a look at the bottom line and then done? Okay, since you are taking this course, if you finish this course and you just take a look at the bottom line, I don't think you can pass the class, right? So please take care that, you know, when you look at the bottom line is just bottom line, right? And all the 4 firms, right, get the same bottom line of 25%, but the story are totally different. Okay, thank you, Celine. Celine, recommend your friends for me. Please, no Amy, okay? Fine. Okay, fine. Okay, fine. So far, have you followed the argument between me and Salin? Do you follow? Okay.
Yes.
Okay. Now, firm A. Okay. Focus on firm A only. Okay. Firm A start with the sales of 100. Is that right? When you calculate the gross profit margin, what is the answer? The gross profit margin, 60%. Am I correct? Okay, I agree with that. I got 60. All right, and then step 1, the gross margin is 60. Then minus operating expense 25. I have core earnings. So Phi, could you maybe, based on your opinions, what does this term mean, core earnings?
Like the earning that you get from like the main product that you're selling.
All right.
Just not other income.
All right. So basically, the earning arising from the main operation or core activities, right? The core activities should be associated with the cost of sale, cost of goods sold, or even like SG&A. Am I correct?
Yes.
Okay. So then you have the core earnings. Then the core earnings should not be included with the other income expenses, correct?
Yes.
Because income and other income and other expenses are treated as a non-core. Is that right?
Yes.
Okay. So then based on firm A, you see that number 3, step 3, the earning before interest and tax and equity income is 40 minus the plus the equity income 15. You get EBIT 55. and interest, blah, blah, blah. At the end, right, net income of 25. Okay, now, Phi, could you please recommend the next friends to me? Any of your next friends?
ลักษณะพลค่ะ
Lasanapon. I think Lasanapon answered already a lot. Okay, could you change to some ladies? Other ladies?
กีวีค่ะ
Kiwi. I haven't talked to Kiwi today. Kiwi.
สวัสดีค่ะอาจารย์
I try to locate your camera. Hold on just a second. Okay. Oh, Kiwi, you are on the beach. Okay, thank you. Be careful, it's COVID-19, okay? Stay distancing. Oh, I want to apologize for this group number 3 because I sent the wrong homework to group number 3. I resent it. Did you get it, Kiwi?
already
All right, yeah. Okay, Kiwi. All right, I like you to focus on step number 1, 2, 3, 4, 5, and 6. Okay, 1, 2, 3, 4, 5, and 6 on the screen. Okay, ready? Can step 1 be negative?
I think it can be, but really unlikely.
Okay, I love that answer. Right, it can be mathematically, but it is unlikely. Okay. Well, I would say that I would ask you this: is that possible that for step 1 to be negative and step 6 to be positive?
Yes,
Is that scary?
a little bit.
I don't think that is a little bit. That is Ladda land. You know Ladda land. Very scary, you know. If step 1 is negative and step 6 is positive, I don't think I'm going to invest my money into this kind of firm. Make sense? All right, now follow me. Step 2, if step 1 is positive, can step 2 be negative?
It can be negative.
So if step 1 is positive and step 2 is negative, it is because
they might have high operating expenses.
Right, a lot of the SG&A that is huge, and it's far large, right? Large that is so large that it's offset the gross margin and turn the core earning to be negative. Is that correct?
Yes.
Okay, thank you so much. Okay, all right. So Kiwi, how about group number 2? Any of your friends in group number 2? Do you know?
I don't know who's in group number 2.
All right. Who is your favorite friends?
They already answered.
Okay, it means that the unanswered friends are not your favorites.
Favorite too.
I'm just kidding. I'm just kidding. Okay, anyone at all?
Everyone in the class already answered.
Okay, good. So Yam, I would like to bother you.
พิมพ์ค่ะอาจารย์
Okay, Yam, will get back to you, but I'm gonna go to Pim first. Okay, Pim.
ค่ะอาจารย์
Oh, where are you? Oh, where are you? Here. I cannot find your camera.
นัทธิดาค่ะอาจารย์
Oh, all right, okay. Okay, Pim. So, Kun Pim, all right, follow with Kiwi, right? Number 2, core earnings. Okay. Number 3, okay, if number 2 is positive, if number 2 is negative and number 3 is positive, hugely positive, is that scary?
Yes.
Why so?
Because it come from non-core earning.
Come from non-core earning, right? And could you maybe give us some example of non-core earnings items? What? Yes, like what?
Maybe disposal. Let me think for a second.
Okay.
maybe from discontinued operation.
That's part of it. And something else like, can it be like this, the gain loss from selling PPE investment? Is that possible?
Oh, yes.
Okay. Normally they are one-time item. Is that right? Right. But some item can be presented on this part as well. For example, interest income, dividend income. Make sense? Right? They are all other income and other expenses. Okay. And follow me, right? If number 1 positive, number 2 positive, number 3 positive, are they okay?
Yes.
But number 4 is negative. What does it mean?
It means that associates and joint venture are not performing well.
Okay. That's why make the whole EBIT, right? Negative. Is that right? Okay. That now, number 4 and 5, right? Normally, if number 4 is positive, right? Number 5 can be positive or negative, depends on the interest expense. But I'm sure that number 5 should be less than number 4. Do you agree?
Yes.
And number 6 should be less than number 5. Do you agree? Right. So analysis of number 5 and 6 should be straightforward, but analysis of number 1, 2, 3, 4 should be investigated when you're trying to analyze a firm, right? As Salin mentioned that we can, just focus on the bottom line because bottom line can be misleading. You have to look at the intermediate step or the details of the earnings, okay? And based on this chapter, the earnings should be analyzed based on the earning management, based on the quality of earning. Do you follow that, right? Okay. So now could you please maybe analyze the firm A income statement for us? Are they okay? Firm A?
Yes.
Okay.
I think firm A is performing quite okay because its earning mainly come from oh wait a minute. Yes, firm A's earning comes from its core earning, and some of it come from other income, and some of it come from associate and joint ventures. But still, it's most of it earning come from core earning, so I think it's quite okay.
Okay, so then based on the first case in the company A, right, you can see that the EBIT, right, of 55 of EBIT, 15 come from the associate and joint venture. Make sense? Okay, and then you can see that this is 5, this is 35. Okay, then 40, 55, yes. So of 55 baht, 35 come from core, 5 from the other non-core, and 15 from the equity income. Am I correct? Right, that's why you conclude that majorities of the EBIT comes from the core. Make sense? Okay. Okay, so now how about from B, Pim?
Firm B is a little bit better than firm A because most of its income, which is 35 of 40, come from core earnings, and only 5 come from other income.
All right. So then, even though firm A and firm B, we have the same sales and same net income on the bottom line, but then the story are different because most of the EBIT come from the core earnings. Am I correct? All right. How about firm C?
Firm C is the best because all of its earnings are from core earning.
Okay, from core earning, but look at the gross margins of the firm A, B, C, right? You can see that firm A, right, most of the expenses, the core expenses are from cost of goods sold, right? But firm C, right, the cost of goods sold is little, but then the selling administrative expense is huge. right? It means that some firms' core expenses might be at the COGS, but the other might be at SG&A. Am I correct?
Yes.
All right. How about firm D-Dog?
Firm D is not very well because it has negative earning, but it have like receive income from other income, so it makes its EBIT become 45. Means that it's not come from core earning.
Right. So the EBIT 45 coming from the other income and the equity income, while core earning is negative. Am I correct? All right. So then in this case, right, we have a lesson learned again based on what I have discussed with Sarin, right? Even though for firm will start with the same sale and ending with the same net profit and yielding the same net profit margin, but the story are totally different. And this is the place where you'll have to learn how to recast the income statement. Okay. Thank you, Kun Pim. All right. So here, back to Yam. Okay, so on the screen you see that this is the income statements, right? Which is the Robinson department store. Have you been to Robinson before?
Yes.
Okay, and Robinson case, that is the retrospective case number 3 that we will study later. Okay, but then I just extract the income statement based on the financial statement on IFRS base. Okay, this is the income statement, not the OCI part, just the net income parts for year. This is the actual figures, 2016, 15, and 14. Okay, I have for you this income, right? Revenue and are there any other income, other expenses in this case?
There is other income.
Right, but not. Do they have other expenses?
No.
No, but do they have the equity income?
Yes, that would be investment income.
All right. Now, before the midterm exam, okay, when you study that before the midterm exam, and when you calculate the profit margin, have you ever wondered the bottom right of the formula? Should I take the net income over the sales or over the total revenue? Should you ever thought about that choice?
Yes.
All right. Okay. And up to this point, what do you think? What is the difference between the sales and total revenue?
I think it depends on the company whether what percentage of sale makes up the total revenue.
Okay, but normally if we don't look at the percentage, right, total revenue should be the sales plus the other income. Am I correct?
Yes.
Okay, and that depends on the choice of presentation as well, right? And some other company might present something very, very interesting. Okay, this is going to be a difficult question a bit. Okay, the question is, when you have the impairment loss, you present the impairment loss as an expense. Is that correct?
Yes.
But next year, the year after that, you have the reversal of impairment loss. The reverse of impairment loss. Would you present the reversal of impairment loss as the other income or negative expense? Do you follow my question?
Yes.
Okay, what do you think?
I think that would be negative expenses.
Why not the other income?
I think we don't actually gain from that. It's just what we recorded and we reverse it off.
Okay, but you know what? There are no requirement. Just say strictly, that way. Because in reality, some firms present as an other income, some firms present as a negative expense, but likely to be negative expense, as you say. So then if they mispresented, the income statement based on IFRS is going to be misleading. Is that correct?
Yes.
So what is the remedies or how to correct that? That's why we have to recast. We have to put the other income and other expenses lumped together as a recasting. That way, we don't have to worry. Is that correct?
Yes.
Another point that I'd like to ask you is about the FX gains and FX loss. How would you present FX gain?
As other income.
How about FX loss?
Negative other income.
Maybe negative other income or maybe just the other expenses. Is that correct?
Yes.
Okay. If you present, if prior year you have the FX gain, but this year you have FX loss, it means that next year you will not have last year you have the FX gain, but this year you have FX loss. It means that total income of last year will be totally different and incomparable with the total income of this year. Is that correct?
Yes.
Then using the income statement based on IFRS might be a bit misleading in terms of the analysis. Am I correct?
Yes.
Okay. Like this example, okay, we have the other income and we don't know what to do. And you can see that I make the total common size of 100 as a total income. But since you just learned based on this previous slide about the recasting, right? And we make the sales as 100. Is that correct? Not the total income as 100. Is that right?
Yes.
Okay. In this case, you can see that if we make the total income of 100, then you're going to have the 100 here. I'm sorry. 100 here. And add the 10 there. So the common size should make the 110 as 100. Is that correct?
No.
It should not be that way. It should be this way on the screen, right? To make the main sale or core income to be 100. Make sense? So by looking at the straightforward IFRS base, that might be a bit misleading, correct? Okay, so this is what you have to do. You have to recast. Recasting the income statement, and based on the result of the recasting, this is what you have. On the next page, this is a recasting. I recast the income statement for you. So right now, I like all of you, okay, all of you to see transformation from the previous slide into this slide. In other words, I like you to see how I recast the income statement, right? Spend time 3 minutes. And then after that, Yam will tell us, okay? Yam, okay, I count on you, right? 3 minutes after that, we will talk, okay? Thank you. right, yeah. All right. Try the best you can. Do not worry much. All right. So go back to original income statement. This is the IFRS based financial income statement. Okay. And you can see that they put the total income in there, right? And they don't even calculate the gross margin for you. Some IFRS based income statement might provide the cost of goods sold, might provide the gross margin, but some might not provide the gross margin. That is an option. Okay. All right. In this case, we call single step. Okay. Why single step? Because they don't give you the gross margin. That's why we call single step. Okay. And based on this, I put the circle in there, 9.93, 8.16, and 8.07. All right. How do you call this ratio, Yam?
Profit margin.
Okay. So profit margin, that is a name, right? And Yam, you know by now that we call profit margin, but then the bottom on the formula might be different. Is that right? In this case, the bottom, that is what the total income. Is that correct? Okay.
Yes.
So when you communicate with the friends, colleagues in the future, by communicating with the formula like with the name like ROA or profit margin, you have to be careful because they might come up with different formula. Am I okay? All right. But in this case, you got 9.93. I'm sure that when you look at the profit margin calculated by the author, the number might be a bit different because we don't know what the bottom is. Is that right? Then we recast. Now tell me, how would I recast? So what did I do?
So you take revenue and cost of goods sold to calculate gross profit first.
Okay.
And then operating expenses, and then you'll get core earnings.
Okay.
And the next step is to include other income and other expenses.
Okay.
And then equity income. And then.
So this is similar to what we have discussed before. Is that right? Okay.
Yes.
And I hope that all the students, all the groups will do the recasting of the income statement for OR. Okay, for the final project. Okay. Jam, personally in your group, did you download the income statement of PTOR? Have you seen already?
Not yet.
Not yet. But when you and the other students download and try to perform the analysis, make sure that you recast the income statement first before you launch any common size or the ratio analysis. Do you follow me? Okay. So please allow me just a little bit to highlight to see things clearly. Cost profit, core earnings. This is the EBIT and profit equity income. And this is the EBIT. Okay, you can call EBIT. I'm fine with this. And then I have this I call EBT. And the last one, that is net income or profit for the year. All right, Yam, so far, are we okay with this? All right. So Yam, if we have discontinued operation, how should we report discontinued operation?
Together with other income and other expenses.
Okay, let me ask you this: Is discontinued operations after or before taxes?
Before.
Before or after? After is after. Okay, go back and review a bit, but I'm telling you the truth. This is after. Okay, by putting the tell me, why would you put the discontinued operations in the non-core earning? What is your argument for it?
Because it's not our main operation and it's likely to be a one-time item.
Okay, and it's belong to the parents and the subsidiary as well, not belonging to the associate or the joint venture, correct? I agree with that, except that one warning. What is my warning? The warning is the other non-core items are before tax, except this guy is after tax. Is that correct?
Yes.
But I would do the same, put into the non-core earning because it's non-core. Okay. Now, more difficult question for you. Hold on a second, please. We have core, earnings, okay? And the core earning comes from revenue minus cost of goods sold minus SG&A, right? Yeah.
Yes.
And then plus or minus non-core earning. Is that right? Then you have, let's say, EBIT and equity income, right? So you have this. Make sense? Okay. The question is, for non-core earning, can some of non-core being weaker and some being non-recurring? Is that possible?
Yes.
All right. Let's say A and B. When you add A and B together, you have the total non-core earnings. But my question to you is that, can non-core earning being group A and some being group B? And you say yes already, right? Could you please give me example of non-core earning being recurring?
Could it be like interest income?
I agree with that. That is one. That is the core thing. I mean, that is the, how to say, the regular components of recurring group A, right? Interest income is non-core, right? Unless you are a bank, makes sense, or financial institutions. But if you are non-bank, you're not supposed to have interest income as a core earning, correct? So it's non-core, but it is recurring, okay? The rest, most of the non-core earning should be non-recurring, makes sense, okay? So be careful. Watch out when you analyze the non-core earning. Watch out non-core earning in group A, because non-core earning in group A can help you predict in the item in the future. Is that right? Because it's recurring by nature. And non-core earning, which is in group A, should be of higher quality than group B. Am I right?
Yes.
Okay. All right. Good. Now let's go back to the story here. All right. So you can see that when I change, I make the 100 as the sales. I make sale as 100. Is that right? So then the profit margin gonna change. Am I right? Right. Before this slide, it is what? 9.93. Is that right? But now I change to be what? 11.49. See, here I am. Some people, they fight to death. They said the other calculate incorrectly, but actually they are calculated correctly, but just different the bottom. Okay, be careful on that, right? Actually, I'm not saying that which one is correct. I would say which one is meeting your expectation or ways of analyzing. All right. So there is nothing like correct or wrong. It's just the way you feel it, right? In this case, I would prefer make the revenue to be 100%, and everything's based on the sales revenue. Okay. And I have the revenue. Question to you, Yam. This is a little bit difficult. Rental income. Why do I put rental income in this section, not in the non-core?
Because Robinson is a department store and they always have, like, one of the main operation would be to rent free spaces to vendors.
Right. In other words, you believe that rental income should be called core earning part. Is that right? Is that going to be nicer if the company present the cost of rental income?
Yes.
If you know, right, had you know cost of rental income, you would be able to generate the gross profit. Is that right? From the segment of the rental. Is that right? But in this case, you don't know. And where are those costs of providing the rental income? It should be somehow mixed into SG&A. Is that correct?
Yes.
Right. In this case, we have no choice, right? Because we cannot separate the cost of rental income from the SG&A. That's why I have to put rental income as in the parts of that. Okay. Now, if you have this, what would you do? You have sales, you have cost of goods sold. Let me just write some artificial number. And you have revenue, and you have a service, 100, and the cost of service, 50. Okay, I would say that you would start with the first line, sales and service, 200, minus cost of goods sold and cost of service in the amount of 70s. Then 130, that is the gross profit. Yeah, am I right?
Huh.
Right, because you just know that the sales revenue and service revenues are the core. You put the core revenue together as 200, and then put the cost of providing that core revenue together as 70s. Then you have gross profit of 130. Is that right? So if I ask you to calculate the gross margin, how would you get? You get 130 over 200, which is 65%. Am I correct? Okay. Yeah, in this case, is it better for you to separately calculate the gross margin for each segment? Can you calculate the gross profit or gross margin?
Yes.
Right. The first gross margin should be what? That is 80 over 100. Is that right? That is 80%. Is that right?
Yes.
And then this one should be 50 over 100. That is 50%. Is that correct? Right. So tell me, I have 3 pieces of information. Piece 1, 2, and 3. You think that when you try to analyze the gross profit margin, only piece 1 is enough? Do you think so?
No.
No, you need to go into detail and calculate pieces number 2 and number 3. Am I correct? Right? But just on the face of income statement, you have no choice, right? But just go for piece number 1 only. Is that right? Right? But then when you have a chance to go into segment level, you better go into segment level. In this case, we have 2 segments. Do you follow me?
Huh.
Okay, now get back to the Robinson. Okay, so we have gross profit, we have core earnings, and we have blah, blah, blah. Now, Yam, just for 2016, could you analyze the performance of Robinson for us?
Let me take a look at it.
Okay.
I think that the earnings of Robinson for 2016 is okay, is somewhat okay, because more than half of the NI still from core operations.
Okay. All right, so if you take a look at this, right, you can see that the core earning of 7.18 as a part, and then about 4, about 2. Am I correct with my writing? Right, 13.94, right? 7 out of 13 come from the core, 4 out of 13 come from the non-core, and then just 2 from the associate. Okay, so I agree with that, but the portion of other income is not immaterial, right? It's not much, but it's not little, correct? Okay, yes. Because if they don't have the other income, the profit margin gonna go lower, about 4%. That is quite a lot. Make sense? Okay. Now, right. How about compare across 3 years? You can see that the gross margin of Robinson, is that a surprise? Yeah. The gross margin across 3 years.
No.
No, but I mean, are they good? You say that? I mean, you see that they perform consistently. Is that right? 24.45, 47.94. Do you think it's go by a fluke, or it's meant to be that way?
I think it's meant to be that way.
Because they prepare the budget, they set the target. Is that right? And basically, across 3 years, right, when they make a sales of 100, they will earn a quarter, right, as a gross profit. Is that right? Just a quarter, right? And then the left of them go forward, cost of goods sold. Makes sense? 3/4. But just a quarter left over is not enough. Maybe we have to look at the core earning. Here come. What happened to core earnings across time?
It increases gradually, and then between 2015 and 14 is pretty close.
Okay. So, but that I mean, back to the last 2 years, that's compared to the current year. The current year is far better. Is that right?
Oh.
Okay. What makes the current year far better than the last 2 years? Allow me to help you. What happened?
An increase in rental income.
Increase in rental income. Makes sense. The rental income increasing here made the core earnings skyrocket. Make sense? Okay. So presenting information this way, it helps you to analyze things clearly. Is that right? Okay. So now go to the step 3 across 3 years. Let me change the color a bit. Here, 11, 9, and 9. Okay. Then you can see that the same thing happened to number 3, right? And then you look at the other income, right? You have seen that the other income go a lot, right? I mean, go up a lot, quite a lot, right? And can we say that this 11.72 caused by other income together with the rental income as well, right? All right. And then the next level, level 4, right? You can see similar, and then you can see that the share of profit of associate goes up a bit as well. Okay. So if I, as a management or as an investor, Yam, and I ask you, could you please tell us how come Robinson performance has increased over time, particularly from 15 to year 16? What would you say?
That part of it from the non-core operations.
Right, and non-core, and then another part that you have to tell is the increasing in rental income. Make sense? Okay. All right, this kind of thing, all right, will be back to you again when I talk about the retrospective case of in Robinson in detail. Okay, but at this point, I would like all of the group to recast income statement of PTTOR. Okay, because when you recast the income statement, you'll be able to, implement the ratio analysis more effectively. Okay, all right. Ajahn, are you gonna assign something? Ta-da! You're gonna have the homework, but not now. I'm gonna tell you later. But here, the rest of the sheet is about the segment report. Okay, as I mentioned to Yam before that, if I happen to sell some goods and I provide the services, right, I need to tell the story about performance in each segment. Why? Yam, why is it important to tell the performance separated by segment?
To better analyze which segment we should pay attention or which segment is currently causing problems. That is correct. And each segment will come up with different risks and return. Is that correct? And that I'm talking about IFRS number 8. Okay, we have the one IFRS, so IFRS number 8 require the firm to disclose information about segment information, right, in the footnote or in disclosure. Maybe you have to check with the PTOR whether they have to disclose information or not. I think they should disclose this because segment report. Okay, in this case, KCE company, they present the segment of the company into 3 segments. All right, the first one that is the prepegs, laminates, and then circuit boards and chemical. And there you go. You can see that they present to you the segment performance, okay, of three segments. The first one is the laminates, and then circuit boards, and the last one chemical. Okay.
And inside the circuit boards, they're separate into geographic area, right? In America, Europe, Asia, and the total. So basically they have 3 geographical area, all right? So yeah, by looking at the segmentation's performance together with the geographical segmentation, you think this formation is useful for investor and creditors?
Yes.
Right, because you can see the performance, right, in each the segment, okay? And we have the column so-called eliminations entries, right? This is for just eliminations of the internal sales, right? I believe that you study advanced one already, right? Yeah. Is that possible for the parent and subsidiaries will have the inter-sales?
Yes.
So when you have inter-sale and you're trying to calculate the figures on the consolidated income statement, you have to eliminate. Am I right? That
Yes.
This is a column of elimination. Then the last column should be the income statement consolidations on the face of income statement. Do you follow me? Okay. Then you can see that you have seen the revenues, right, separated by segments and the segment profit. Okay, you can see now. Okay, now if I put the color in there, okay, let's say A, B, and C. It means that I give to you the segment profits of segment A, segment B, segment C for 2015 and 14. YAM, just be the representative of the class. Which segments earn the highest profit?
B.
B, which is circuit board. Is that right? That is quite a lot. Okay. Now, if you want to express in terms of the percentages, you need to calculate, right? By take the profits over some number like sales. Make sense? Okay. Right. The next page, that is the asset, right? Separated by each segment. Yeah. If we know asset by each segment, and if we happen to know segment profit, can we somehow calculate somewhat ROA?
Yes.
Yes, but not really like ROA that we calculate, right? It's going to be somehow modified ROA kind of version. At least you will know exactly like how they did in terms of using the asset to generate the segment profit. Am I correct? Right? So, and then they just disclose information about major customer as well. Okay. Yeah, if you make a huge sales externally, would you like to make a huge sale to some particular customer or many or a lot of or large number of customers? Would you wish to have the sale cluster in some big customers?
I think too many customers, because otherwise we would be solely dependent on that customer to keep buying from us.
That is correct. We have customer risk. Is that correct? What happens if we the sale a cluster on big customer? What happens if that customer, right, decline to buy the product from us? That's why the income, that's why IF number 8 require the disclosure of the major customer as well. Okay, and here you go. Revenue from the 3 customers. All right, 3 customers, blah, 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 approximately 5.6 million, blah, 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 of group total revenue. If you look at the total group revenue, right, that is not quite a lot, right? So it means that the 3, they don't disclose who are they, because the IFRS didn't want to disclose that confidential things, okay? But at least you will know the customer risk. So in a nutshell, yeah, you think that segment reports, disclosure are very useful.
Definitely.
Yes, and doing the recasting are very useful for helping you to analyze the ratio. Yes, right? Okay, so we are done with this chapters, okay? So now I'm gonna assign the homework for you. So yeah, recasting, in your opinion, would you like to practice doing the recasting?
Yes.
Yes, okay. So here you go. All right, so everyone, Jam, do you see on my screen? What company is this?
BEC.
All right, and you see the other company? Thai Union, right? Okay. After today's class, I will put these two files, right, on the blackboard, and please download. And the homework is easy. Yam, what is my homework?
To recast for the two companies.
That is correct. Okay. I will ask you to recast the income statement of BEC World and recast the income statement of the TU, right? To be all right. To be easy for you, Yam and the other student, please do not worry about separate financial statements. Okay. Just focus on the consolidated income statement. Are we okay? Yam, is that clear? All right. For two company, right? Recast the consolidated income statements. Okay. And the deadline, since it is Songkran festival, okay, I allow you to turn in the homework like Tuesday, I think 18 or 19. Does anyone know exactly? 18 or 19 of April. That Tuesday. That Tuesday, okay? You have about 2 weeks, okay? So do not worry much. So then don't turn it to me on Songkran festival, okay? All right, so then please, I will put it after the class, right, to download and then recast. And for the BEC World, you will see a lot of things going on with a bunch of the other items. Now it will somehow check yourself whether you understand the IFRS or not, because there are going to be more transactions, all right? Okay, and for the TU, this is very challenging because they have what? Yam, what is this one?
Discontinued operations.
Exactly, okay? So then these two companies are good homework for you to practice recasting, because when you work on PTOR, you have to recast, okay? So then again, the due date is Tuesday after Songkran, I think 18 or 19, as before, okay? Now, I think with the time and the chapter left over, I think I'm short. And since next Thursday, that is the holiday, okay? I'll not see you, but this is what I'm gonna do. I'm gonna tape, right? Make a clip on the next chapters on cash flow, okay? So I will make a video clip on cash flow next chapters, and I will put on the blackboard, all right, for you to study yourself, because next Thursday we will not see each other, correct, Yam? Okay, so then I will put the clip. When I'm done with clip, I will line you in the group line to tell you. And then please, next Thursday, even though we haven't seen each other, please study the clip on next chapter on cash flow statements. And in the future, if I don't have time to conduct the online class, I might do the clip video, right? So that I will not have to rush the lecture. All right, I think this way might be better for you, okay? All right, I think that's it. And during the Songkran festival, right, if someone asks me, Ajahn, what do I do with the PTOR so far, okay, just calculate the ratio, download the income statement or the financial statement, and recast the income statements and calculate the ratio, DuPont and everything, okay? And I will talk more about the details of the final project after Songkran. We have time, do not worry. And I will not ask you to do a lot of things as compared to last term, okay? This term, the final project are gonna be minimal. Basically, I will demand just one page of the executive summary and the other pages, right? For example, the recasting income statements and then common size and then some ratio. Okay, I will talk more about that, but take Songkran festival as a holiday and partially working on some things, right, on this subject. Otherwise, all right, I will see you again, right, after Songkran festival about 18. I think that is 20. Yeah, Tuesday, not 20. What day is that? What is the day that we will see each other again? What is that date?
I think
okay.
It's 22.
22, yes, thank you so much, right? I will see you again. Wow, that is April 22. And then we up to that, well, starting from that day, 22, we have 3 more classes. So then again, From today till 22, you have my clip video on Blackboard. I will tell you when it's ready. Otherwise, take care of yourself and happy Songkran Festival and happy family days, okay? I will stick with you for a while, but I will shut down the record and you can ask a question. Otherwise, see you again. สวัสดีครับรักษาสุขภาพนะลูกครับสวัสดีครับ